It's good to have you here. And when we look at what's going on with this earnings season, you've pointed out that consensus expectations for the S&P 500 by the end of the year to be around $189 a share. Are investors pricing in too much, expecting too much regarding earnings? Because there's still a way to go to hit that.
Yeah, good afternoon, Adam. Good to chat with you. Really, the backdrop to everything we're seeing in the market today is that the economy is shifting from this recovery phase where you see these big percentage increases to an expansionary phase where those percentage increases should moderate over time. And that's true across things like inflation, interest rates, but also earnings, as you point out. And right now, still, earnings expectations are quite lofty, not just for the S&P 500 overall, but within sectors, especially if you look at areas like energy, materials, consumer discretionary, and technology. So a lot is, in fact, baked in. We think that we're still in the phase of the cycle where companies can still continue to deliver outsized expectations. And that's kind of what you're seeing this earnings reporting season. About 88% of companies are beating expectations. And we think that'll continue for a little bit of time as the economy continues to accelerate before it hits that plateau in terms of the peak growth rate.
And James, how are you thinking about this idea of a peak growth rate? I mean, are we really going to see a market deceleration in the second half of the year as it relates to GDP and corporate earnings growth? Because, of course, yesterday we had that downgrade on U.S. GDP growth coming from Goldman Sachs. We've heard a number of economists really tempering their outlook. So what is your assessment of what that deceleration is going to look like?
Yeah, that's a great question, Emily, because that's fundamentally what's driving the markets right now. It's about how much will it decelerate off of this huge recovery bounce. And, the same was true for inflation. You saw these 5 to 5.5% CPI rates on a year-over-year basis. That is probably not sustainable. That's just an arithmetic base effect. And over time, that should come down. Even if it's above 3%, it's a very big difference between those numbers. So from a GDP perspective, we do expect GDP growth rates to slow over time. Still, we have already exceeded pre-pandemic levels on GDP. So that's happened 2 quarters faster than expected. Originally, economists the consensus estimate expected that wouldn't happen until the end of this year. It's already happened. And if you take a look at earnings, we still expect to get to, like Adam said, about $189 for S&P 500 earnings, which is a very, very solid growth rate. And then over the next 2 years, that should decelerate to about a 10 to 11% growth rate year over year. So these are still fantastic growth rates. We are still early in the cycle, but we do need to moderate those expectations, especially because valuations are so high with all the expectations of the past year already built into them.
We heard Inez refer to what was going on in China and the fear that some investors have. Do you think there's been an overreaction by investors who might be shunning emerging markets? And it's kind of funny that we still refer to China as an emerging market, but shunning emerging markets, whether it be China or others?
We do think there is an overreaction, but in a very specific way. So clearly, from an individual stock perspective, maybe an individual sector perspective, especially in education, there's something very political and regulatory happening there that's specific to the Chinese government. That being said, emerging markets overall, when you invest in those, you expect this type of volatility. You expect a certain level of political, social, and even regulatory risk. So we think that eventually this will play out in those sectors. But overall, emerging markets, we still find quite attractive, especially relative to the U.S. Folks are always looking for opportunities to build positions in places like emerging markets, especially because they're cheaper than U.S. and developed market stocks. I think it's important to understand that these types of risks can happen, especially in a place like China. It's a very big market, but it is still an emerging market from the perspective that there are these political and regulatory risks. And so we still think it's an important part of a portfolio. And for those who are underexposed because the U.S. has ripped so much over the last year, maybe now is a good time to start shifting the balance a little bit within that portfolio.
And James, speaking of balances, what balance do you think investors should be striking right now between that reflation trade and those cyclical stocks versus some of those growthier areas of the market?
Yeah, that's an important question because a lot of these trades are still playing out today. What you've seen so far this year is although the S&P 500 is up double digits, a lot's happened in terms of the rotation underneath the surface. So I think it's important to break it down to 2 parts. One is that the rotation, the sort of reopening trade, if you want to call it, or this expansionary growth trade, we think that that's still in play, right? It's a shift from what we saw last year in terms of things that benefit from the lockdown, you're still going to see the reverse of that this year. And then when you look at areas like technology, although there's some volatility, today and this week, really that's a secular story. It's not, a short-term rebound in the economy story. It's about the growth in digital technologies. It's about the growth in, areas like cryptocurrencies becoming more part of the market, right? So all that is expanding, and that's a secular story over the next several years and not just over the next several months.